The Supreme Court just blew a hole in a huge chunk of the tariff regime, and Wall Street just got handed a surprise worth roughly $175 billion. And if you don't fully understand what that means for your money, it probably means you have something healthy like a social life. Meanwhile, the big funds are already moving, quietly, systematically. And if you wait for the evening news to explain it, you're going to be the last person to react. Here's what's driving me nuts. Most coverage is arguing politics, personality, and outrage. I don't care. What matters is what this does to inflation, interest rates, corporate margins, supply chains, and sector leadership. Because tariffs aren't just trade policy. They're a tax. A tax that hits some companies directly, hits others indirectly, and can flip entire portfolios depending on where you're exposed. So in this video, I'm going to give you a 5-step tariff protection framework. Not theory. A practical way to think, position, and manage risk through the chaos. So you're not the person panic selling the wrong thing at the wrong time, or chasing the winners after they've already run. And by the end, you'll have a clear answer to one question. Given what just happened, what do I do with my portfolio this week? Quick note, this is education, not financial advice. Use your brain, do your research, and size your risk like an adult. All right, what actually happened? Because the media is making this way more complicated than it needs to be. A Supreme Court ruling struck down a big set of tariffs that had been imposed under a law called the International Emergency Economic Powers Act, IEEPA. That law dates back to 1977. It was designed for emergencies, sanctions, freezing assets, restricting transactions. It was not designed as a blank check for tariffs. And the court's point was simple. The Constitution gives Congress the power to tax imports, not the president. So if the executive branch uses an emergency powers law to impose broad tariffs, the court's basically saying, no, that's not how the separation of powers works. And it wasn't a narrow technical ruling either. A key ingredient here is something called the major questions doctrine. Again, simple translation. If an action has massive economic impact, Congress needs to clearly authorize it. You can't just stretch old laws until they cover whatever you want. Why should you care? Because this isn't just one policy being reversed. It's a constraint being placed on how tariffs can be imposed going forward. And that changes the playbook. Now, one detail that matters, this wasn't just partisan theater. 2 justices who were appointed by the very administration that pushed the tariff approach still joined the majority. That signals something important to markets. This isn't just politics. This is legal structure, which means it's harder to ignore. Now, here's the number everyone is going to talk about for months. Roughly $175 billion in tariffs had already been collected under that authority. Collected. Real money. And the ruling didn't magically say, refund it tomorrow. So now you've got a mess. Because companies are lining up saying, we want that money back. And courts are going to be flooded with claims, procedural fights, eligibility arguments, timelines, appeals, and a lot of very expensive paperwork. That money doesn't just vanish. It becomes a multi-year legal and accounting event. And that's the first big lesson. The market may react in a day, but the cash flow effects can play out over years. So don't trade this like a one-day meme headline. Now, immediately after the ruling, the obvious question became, okay, so tariffs are gone? No, not even close. And this is where retail investors get whiplash, because they think in binaries. Tariffs on, tariffs off. Real life is, tariffs shift from one legal basis to another, timelines change, and uncertainty increases. Within hours, a new tariff announcement showed up under a different legal authority, Section 122 of the Trade Act of 1974. And Section 122 is basically a temporary lever. It can allow tariffs up to 15%, but only for a limited period. Roughly 150 days. After that, extending it requires Congress. So we go from a world of broad executive emergency tariffs to a world of temporary tariffs unless Congress steps in. Which means 2 things at once. 1, some tariffs may be lower than before, depending on category and negotiation outcomes. 2, uncertainty just went way up, because timelines and approvals now matter more. And markets hate uncertainty. But traders love it. Now, let's get specific. Not every tariff changed. Some categories, like certain metals, were under different authorities and remain in place. China also remains a special case, because a new global tariff layered on top of existing ones means their effective rate can still be substantially higher than other countries. And negotiated deals that were based on the previous tariff structure suddenly get reset. Countries and companies that thought they had clarity now have a new, moving target. So if you're thinking, this is bullish because tariffs got cut, slow down. Sometimes it is bullish, sometimes it's not. It depends on what you own. And it depends on what your companies import, what they export, how they price, and whether they compete with foreign producers who just got cheaper. Now we get to the part that matters, what this does to your portfolio. Because the tariff story is not a story about trade. It's a story about margins and inflation. Tariffs are a tax on imported goods. So when tariffs rise, input costs rise for importers. Some of those costs get passed to customers. Some get absorbed. Either way, it changes profit margins and consumer prices. When tariffs fall, that pressure can ease. But only if companies actually see relief in practice, and only if the new tariffs don't replace the old ones with a different label. So, we need a framework. Here it is. 5 steps. And they're not complicated, but they stop you from doing what most people do, which is panic react to headlines and trade your emotions. Step 1. Get the baseline right. You need to understand where we were before the ruling, where we are after, and what might snap back in 150 days. Before the ruling, the effective U.S. tariff rate had reached levels not seen in many decades. After the ruling, estimates suggest the effective rate drops meaningfully, still high historically, but lower than it was. Now here's why that matters. Tariffs feed into inflation. Not perfectly, and not instantly, but enough to matter for policy. One rough rule of thumb some analysts use is that each 1% change in effective tariffs can move inflation by around 0.1%, give or take. Don't treat that as gospel. Treat it as a way to think. If tariffs drop materially, inflation pressure can ease. If inflation eases, the central bank has more room to cut rates. If rates can be cut, growth stocks breathe easier. That's why markets often like tariff relief. But now add the twist. A new tariff authority comes in with temporary measures. So the real story is not tariffs are lower. The real story is tariffs might be slightly lower, but uncertainty is higher. And uncertainty affects investment decisions, supply chain decisions, hiring decisions, and consumer confidence. So step 1 is about being honest. You're not in a stable environment. You're in a regime where policy can swing, and the swing itself is a risk factor. Step 2. Map your exposure properly. Most investors do this wrong because they look at their portfolio and think in company names. You need to think in economic sensitivity. Ask these questions. Which of my holdings import a lot? Which rely on foreign components? Which have supply chains that pass through multiple jurisdictions? Which compete with foreign sellers on price? Which benefit when foreign goods get more expensive? Which get hurt when foreign goods get cheaper? Here's the simple taxonomy. Import-heavy retailers and consumer brands often get hit by higher tariffs. If tariffs ease, that can help margins, eventually. But there's a catch. Refunds. Some big importers and retailers are now lining up for potential refunds on already paid tariffs. That's a potential windfall. But it's also a legal slog. So don't price it like free money tomorrow. Meanwhile, domestic producers who were protected by high tariffs might actually dislike this ruling. If foreign competitors get cheaper, domestic pricing power can weaken. And then you've got the reshoring ecosystem, industrial automation, construction, logistics, domestic manufacturing enablers. High tariffs create incentives to bring manufacturing home. If tariffs become less certain, those incentives get messier. So you can't just say, tariffs down equals good. Some companies win when tariffs rise. Some win when tariffs fall. Some win when tariffs are stable. And some get destroyed by uncertainty regardless of direction. Now here's the underappreciated group that often benefits from uncertainty. Market makers, exchanges, brokers, banks. Why? Volatility drives trading volume. Trading volume drives revenue. So when policy makes markets whip around, the plumbing of finance gets paid. That doesn't mean those stocks always rally, but it's a reminder. Chaos is a business model for some sectors. Step 3. Understand second-order effects, not just direct costs. This is where most people miss the real move. Tariffs aren't just a line item on import costs. They ripple through the system. Here's the chain reaction you need to keep in your head. Higher tariffs can raise import prices. Higher import prices can raise inflation. Higher inflation can keep interest rates higher. Higher interest rates can strengthen the dollar. A stronger dollar can make U.S. exports less competitive. Less competitive exports can widen the trade deficit. A widening deficit can create political pressure for more tariffs. It becomes a loop. Now, if tariffs are partially rolled back or constrained, inflation pressure can ease. That can shift the interest rate path. And that can shift which sectors lead. That's why markets react so hard to tariff headlines, because they're not trading trade policy. They're trading rates and liquidity expectations. So here's the practical question you should ask. Does this ruling increase the probability of rate cuts? If yes, what parts of your portfolio benefit from lower rates? Typically, long-duration growth stocks, some tech, some consumer discretionary, some small caps, depending on the economic backdrop. If no, or if uncertainty keeps inflation sticky, what benefits? Typically, quality cash flow businesses, pricing power companies, some defensive sectors. But the real answer will depend on how policy evolves over the next 150 days, because that temporary tariff clock matters. Step 4. Stop predicting and start observing what the big money is doing. Retail investors love to predict. They say, I think tariffs will go up, or I think tariffs will go down, and they bet the farm. Professionals do something different. They watch flows. They watch positioning. They watch where institutions are adding and where they're trimming. And you can do this without secret access. You can observe sector performance relative to the market, industry rotation, credit spreads, dollar strength, bond yields, earnings revisions, guidance language. And if you want a dead simple practical approach, instead of staring at 50 individual stocks, track which sectors are gaining relative strength after the ruling. Because money moves in herds, first by sector, then by industry, then by the best individual names. That's how the wave forms. So what is the big money likely doing right now? Not everyone is doing the same thing, but here's the institutional logic you should understand. 1. They're stress testing supply chain exposure. 2. They're looking for companies whose margins were hit by tariffs and could recover if relief sticks. 3. They're cautious on anything that requires stable policy to justify heavy capital investment. 4. They're watching rate expectations because tariffs and inflation are linked in the market's mind. And 5. They're buying volatility itself in some cases because a 150-day cliff creates event risk. The number one retail mistake during policy volatility is this: holding positions with no exit plan. Because if policy flips again, the market can gap down. Not drift down, gap. So step 5 is risk management. And this is the part that separates investors from gamblers. Every position you hold should have a tripwire. Meaning, at what point do you admit you're wrong? Not emotionally, mechanically. Some people use a percentage drawdown. Some use technical levels. Some use volatility-based stops. The method matters less than the existence of a rule. Because in regimes like this, you're going to be wrong sometimes. Everyone is. The goal is not to be right every time. The goal is to avoid the kind of losses that permanently set you back. Small losses are normal. Large losses are usually the result of no rules. Now, let's make this framework tangible with a few examples of how tariffs and tariff uncertainty show up in real portfolios. If you own large retailers or consumer brands, ask, how import-dependent are they? How fast can they raise prices? Do they have alternative suppliers? Do they have bargaining power with vendors? If tariffs ease, their input costs can fall. But competition can also intensify because everyone's costs fall. So it's not just cost down equals profit up. It's who keeps the savings and who passes it on. If you own domestic manufacturers, ask, were they protected by tariffs? If yes, could they face more foreign competition now? If foreign goods get cheaper, Do they lose share? Or do they have enough quality differentiation that price competition doesn't matter? If you own industrials linked to domestic build-out, ask, does uncertainty slow investment decisions? Or does the broader reshoring and security trend continue regardless? Sometimes uncertainty delays projects. Sometimes it accelerates build local decisions because the world feels unreliable. Both can be true in different sub-industries. If you own tech hardware and electronics exposure, remember, supply chains are global. Even American products can contain foreign components. Tariffs can shift cost structures and pricing strategies. But the bigger driver for tech may still be rates and demand. So don't isolate tariffs as the only factor. Now, let's address the emotional trap. When people hear tariffs struck down, they think, great, inflation drops, rates drop, stocks go up. And sometimes that's true, short term. Markets love relief. But the medium-term story is messy. Because the ruling doesn't end tariffs. It changes the mechanism. It increases legal uncertainty. It increases negotiation uncertainty. And it creates a timer. That 150-day window is a cliff. And markets will start pricing that cliff well before day 150. So if you want to be positioned like a professional, you think in timelines. Here's the timeline logic. Immediately, relief trade, rotation, headlines. Next few weeks, companies and lawyers position for refunds, guidance language shifts, analysts update models. Next few months, negotiations, policy signaling, potential new tariffs under other authorities, supply chain adjustments. As the 150-day expiration approaches, volatility increases again. Then, either Congress acts or it doesn't. And that becomes a new regime decision. Now add another layer, elections and political incentives. Because if Congress is required for permanence, political alignment becomes more important. This isn't a political video. But as an investor, you have to admit reality. Policy outcomes depend on political outcomes. And markets will price probabilities. So what should you do now, this week, in practical terms? Run the 5-step framework. 1. Baseline reality. Effective tariff rate changed, but uncertainty increased. 2. Map exposure. Importers, domestic producers, reshoring, financial plumbing. 3. Second-order effects. Tariffs, inflation, rates, dollar, earnings, and competitiveness. 4. Observe flows. Which sectors are gaining relative strength after the ruling? 5. Tighten risk management. Define your exits before the market forces you to. Now, I want to talk about one subtle point that most retail investors miss. Sometimes good news is already priced in. Sometimes the market's first move is the obvious move. Then, the second move is the real move. What do I mean? The obvious move is tariffs down, inflation down, rate cuts up, growth stocks up. The real move can be, wait, uncertainty is higher, legal fights drag on, CapEx pauses, and inflation doesn't fall as much as expected because other tariffs remain or new ones replace them. So don't chase the first move blindly. Let the market show you which move is real. That's why relative strength and money flow matter. Now, let's be honest. This environment is going to be full of fake-outs. You'll see rallies that reverse, sell-offs that bounce, headlines that contradict each other within 24 hours. That's not a bug. That's the regime. So your portfolio needs to be resilient. Resilient doesn't mean never down. It means you survive volatility without making catastrophic decisions. And resilience comes from position sizing, diversification across drivers, and exits. Now, one more thing about the $175 billion windfall narrative. Be careful. Not all of that becomes profit. Some of it gets competed away through lower prices. Some gets absorbed by supply chain renegotiations. Some gets delayed for years. Some gets eaten by legal costs. And some companies won't even be eligible in the way headlines suggest. So if you're buying a stock because you think it will get a refund, you're speculating on legal outcomes and timelines. That can work. But treat it like speculation. Size it like speculation. And if you're not comfortable with that, don't do it. Now, what's the biggest strategic takeaway? It's this. We're in a world where trade policy is becoming a recurring market variable, not a once-a-decade event, a recurring variable. That means Supply chain resilience becomes valuable. Domestic production themes remain relevant. Pricing power becomes more valuable. And investors should stop treating policy as background noise. Because policy is now part of the earnings model. And if policy is part of the earnings model, then risk management becomes more important than ever. So let me give you a simple checklist you can run every time a tariff headline hits. First, is this a direct cost change or a timing change? Second, is it permanent or temporary? Third, who absorbs the cost? Company, consumer, supplier? Fourth, what happens to inflation expectations and rates? Fifth, what is the market doing? Where is money flowing? That checklist will keep you from doing what most people do, which is react to vibes. Now, let's summarize the entire situation in clean terms. A major set of tariffs imposed under emergency authority has been struck down. That potentially reduces the effective tariff rate materially. It creates a messy, multi-year refund fight around about $175 billion already collected. A new tariff authority has been invoked to impose temporary global tariffs with a 150-day clock. Some categories remain under other tariff authorities. China remains a special case with higher effective rates due to layering. The immediate market reaction can be relief, but the medium-term environment is higher uncertainty, and that uncertainty will create sector dispersion, volatility, and opportunity. If you're positioned with no plan, it will also create pain. So don't do what the average investor does. Don't watch this like it's entertainment. Treat it like what it is, a structural change in how tariffs can be implemented, which means a structural change in the risk profile of certain sectors. And the only sensible response is, know your exposure. Watch the second-order effects, follow the money, and manage risk. If you do that, you don't need to predict the next headline. You just need to be prepared for it, because the next headline is coming, and the one after that, and the one after that. That's the regime. And in this regime, the investors who survive are the ones who are systematic, not the ones who are certain. If this was useful, send it to one person who's still stuck in the mindset of tariffs are just politics. Because for markets, tariffs are not politics. They're numbers, they're margins, they're rates. And they're the difference between being early on a rotation or being the person who sells at the bottom and buys back at the top. That's the real cost of not understanding what just happened.